Welcome. Today, we're dissecting Donghua Shun, a true giant in China's financial services market. But as we'll see, beneath its impressive growth, there's a fundamental tension. A tension between its current reality and its future ambitions. Our analysis will deconstruct the two key forces that are shaping this fintech leader right now. So let's start with the conclusion, our central thesis. It's this. Donghua Shun's story is really defined by a core tension. On one hand, you have a dominant market leader posting phenomenal growth, but that performance is being supercharged by its highly cyclical advertising business. At the exact same time, its valuation appears to fully price in a future transformed by artificial intelligence. And that creates this potential disconnect between where the company is today and what the market expects for tomorrow. Now, to really understand this tension, we first need to dissect the company's revenue. We have to pinpoint exactly where this recent surge in growth is actually coming from. Okay, if we look at the data for the first half of 2025, it reveals a pretty striking divergence. You see, the company's largest segment, which is value-added services, grew a very respectable 12%. But that's just dwarfed by the advertising and promotion business, which expanded by an explosive 83.2%. And at the same time, fund sales were basically flat. So what we're seeing is a clear two-speed growth engine at work here. And this visual makes that disparity even clearer, doesn't it? The advertising business is really acting as a high-octane booster rocket for the company's overall growth. In stark contrast, its foundational subscription and fund sales businesses, well, they're moving at a much more stable but far less dramatic pace. So what this all means is that the company's impressive top-line growth is being disproportionately driven by its most cyclical segment. The advertising business absolutely thrives on market excitement, and that, by its very nature, introduces a significant amount of volatility into the company's financial narrative. So, the natural question is, how does the company plan to mitigate this heavy reliance on market cycles? Well, the answer seems to lie in its strategic pivot to artificial intelligence. It's an attempt to build a new and hopefully more durable foundation for growth. Now, Donghua Shun's strategy isn't to just adopt some off-the-shelf AI. No, it's building its own vertical large language model called HithinkGPT. The idea is that by training this model exclusively on decades of financial data, the goal is to achieve superior accuracy and domain-specific intelligence. Essentially, they're trying to avoid the reliability issues that often plague general models when you apply them to a highly specialized field like finance. The path to actually monetizing this pretty significant investment is two-pronged. For its massive retail user base, what we call the C-end, the goal is to integrate AI into its premium subscription packages, justifying higher price points. But then, for the B-end, the plan is to license the HithinkGPT model itself directly to institutional clients, creating an entirely new revenue stream from the enterprise side. This quote really reveals the core of their AI strategy. You know, as general AI makes raw data more and more of a commodity, the company's defensible advantage has to shift. It has to move towards providing intelligent analysis. This is Donghua Shun's planned evolution from being just a data provider to becoming an insights engine. However, for all of its forward-looking ambition in AI, the company's current financial reality, well, it remains firmly anchored to the cyclical nature of the stock market. And this correlation isn't just anecdotal. When you look at the historical performance, it reveals a clear, persistent pattern that ties the company's fortunes directly to the ups and downs of the A-share market. The linkage here is just explicit. Look at the 2020 bull market. Revenue and profit growth were absolutely explosive. But then, as the CSI 300 index fell in 2022 and 2023, growth just stalled, and net profit actually contracted. And the rebound we saw in 2024 further solidifies this direct relationship. It's pretty simple. As the market goes, so goes Donghua Shun. And this brings us right back to where we started. That 83% explosion in advertising revenue we saw earlier, it didn't happen in a vacuum. It was directly fueled by a 64% surge in average daily trading volume in the A-share market during that same period. When the market is active, Donghua Shun's advertising business absolutely thrives. This all brings us to the central conflict of our analysis, how the market is valuing a company with this really pronounced dual identity. One part highly cyclical, and the other part highly visionary. So, the market valuation can really be seen as the result of two competing narratives. The bull case views Donghua Shun as a technology company on the cusp of an AI revolution, and that justifies a premium valuation. On the flip side, The bear case sees a mature financial services firm, subject to market cycles, whose valuation has maybe become a bit detached from its more modest underlying growth. We can actually quantify this tension when we look at relative valuations. Tonghua Shun trades at a trailing 12-month PE ratio of around 98. Now, that is more than double the multiple of its closest competitor, Eastmoney. Such a significant premium indicates that the market has exceptionally high expectations for future growth, and those expectations are largely predicated on the success of its AI strategy. So this brings us to the defining question for investors and analysts alike. Is Tonghua Shun fundamentally an AI company that just happens to operate in finance, or is it a finance company that is simply using AI? The answer to that question will likely determine its future valuation, its strategic direction, and indeed the entire next chapter of its story.